Good afternoon, ladies and gentlemen, and welcome to the BlackRock Smaller Companies Trust PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish those responses where it's appropriate to do so on the Investor Meet Company platform. Before we begin, we would just like to submit the following poll, and if you'd give that your kind attention, I'm sure the company would be most grateful. And I would now like to hand you over to Portfolio Manager, Roland Arnold. Roland, good afternoon, sir.
Good afternoon, and thank you to everyone for attending this call. This call is to discuss the BlackRock Smaller Companies Investment Trust. This is a portfolio that I've run for a few years now. I'm Roland Arnold. I'm a director on the emerging companies team at BlackRock. I've been running portfolios since 2006, so the best part of 20 years, and over 20 years investment experience. I manage roughly 1.8 billion of assets across UK small, mid cap, and all cap. I think first thing, it's worthwhile reminding people what the strategy of the trust is and what it is that we are trying to accomplish. The BlackRock Smaller Companies Investment Trust looks to source alpha through small and mid-cap investing in the UK market. We believe that there are 5 distinguishing characteristics of good quality long-term small and mid-cap holdings. And this portfolio investment strategy is the one that we have had for many years now. First and foremost, we believe that management teams are critically important in this part of the market. We're looking for founders, entrepreneurs. We're looking for management teams that we can get to know over a period of time, that have a history of guiding businesses through difficult and challenging market circumstances, but also taking full advantages of when markets are more positive. And that tends to come, that ability, that advantage tends to come from having market-leading positions that have leads to businesses having pricing power, businesses that have something about them for the mid to long term, so that good long-term track record. Whilst this presentation, like many of you in financial markets, will have a number of disclaimers that talk about how past performance is not necessarily a guide, we tend to think it's small and mid-cap investing, and actually that past performance really is quite useful as a guide because it tells you something about the product that the company makes or a service that it provides. And the fact that over time that product has been useful and valuable to a number of people suggests that it will be in the future, particularly if it's got a leading market position, which gives it pricing power and the ability to reinvest in the company. We look for well-capitalized businesses. We don't believe in the idea of efficient balance sheets in small and mid-cap investing. The efficient balance sheet is the wrong way to think about it. It's the appropriate balance sheet or the right balance sheet for the business that you're invested in. This end of the market, businesses by their very nature are less mature. And so we want to have well-capitalized, strong companies where if there is a problem, a short-term problem with the earnings, that we don't augment that with a problem about the solvency of the company. We'd like to know if they can work their way through all market circumstances. And then cash generation is important to us. It's important to us for a couple of reasons. Firstly, because if cash generation is there, that suggests that profits are there. When profits and cash mismatch, typically it's the profits that are overstated, not the cash. The second is that we're looking for companies that can fund their organic growth by themselves. We don't want them to have recourse to investors to fund that organic growth. We like their businesses to do that themselves. We're here for M&A and non-organic purposes, but businesses should be able to fund their own development. And how we seek to identify these companies through these 5 criteria is by meeting as many possible. So we do somewhere between 700 and 800 company meetings a year as a team. That is the basis of the primary research and proprietary research that we carry out. And we think company meetings are really important in terms of the investment process. They tell you an awful lot, not just about the company you're looking at and analysing, but about their supply chains, about their markets, about economies in general, about consumers, about sentiment, about all sorts of other things, pricing environments, inflation, supply chains. And so each company meeting tends to be a good source of idea generation for future companies. It tends to lead you down a road of further research to carry out. And then what we're looking to do is identify these companies and to put them into a portfolio, a bottom-up fundamental portfolio, where stock selection is the primary driver. We think less about sector allocation and the macroeconomics, although it does form part of our framework, But for us, it's very much about identifying the companies from the bottom up that we think deserve a place in the portfolio for the mid to long term, companies that we think compound over a number of years. This slide shows the performance of the trust over recent years. The performance last year, I think we can loosely define that between two different points of the year getting into, and that is the period up to the government's Black Hole Day and the period afterwards. In the period up to Black Hole Day, we had taken the view that a Labour government, an overwhelming majority Labour government, would be the sort of stabilisation that the UK needed. We had a portfolio that was very much leaning into a recovering domestic focus. Clearly, what happened post the election and the discovery of the 22 billion black hole leading into the budget was actually less stability than we had hoped for, and that had a direct impact on the performance of the portfolio last year. We will delve into market environment. In fact, we'll do so now. So as a reminder, BlackRock Smaller Companies' present portfolio has a quality growth bias. And the last few years, quality growth is not where you've wanted to be as an investor. This chart shows the MSCI UK small cap versus value versus growth indices. And you can see actually since the 2021 start of this period of underperformance, there's been roughly 20% underperformance of growth versus value in the UK small and mid cap. And that's been a headwind to the investment strategy of our portfolio and speaks to a whole host of things. It's clear that for a period, the valuation of growth did become extended, particularly in a world of low interest rates. But we have tried to stay true to that growth mantra for the investment strategy all the way through this. We do believe that the valuations, which will come on to a moment between growth and value, have compressed to very attractive levels. Another way of looking at growth versus value is to look back over the longer term. This chart here is from Deutsche Numis, and it shows the performance of value in the Deutsche Numis Smaller Companies Index going back to 1960. It shows the rolling 5-year performance of value over growth. So anywhere where the blue is above the x-axis, that is value outperforming, and where blue is underneath, that is value underperforming. And by proxy, that suggests that growth is outperforming. When you look at this slide, a rational investor would quite rightly ask the question, given that the long-term performance suggests that value does better more of the time, why would we look to have a portfolio that is actually more growth orientated? And it is a fair question. I think firstly, you have to think about the timescales and durations here. Yes, for a large part of this period, value outperformed, but that implies that, or to believe that continues in the future, implies that companies themselves haven't changed, the dynamics of companies haven't changed, and we don't necessarily think that's true. Over this 65-year period, there have been some profound changes to the way that companies are organized, the way their capital structure is set. Companies now tend to be lower capital employed, higher return on capital. They tend to have more variable cost bases. They tend to rent their computing power through clouds, for instance, or they rent their property space rather than entering into long-term leases. They use short-term contractors rather than long-term employees. There are ways that they can manage and scale their costs in a way they couldn't do before. But what really has changed is the ability of companies to scale in a way that wasn't possible 20, 30, 40 years ago. Companies can launch digitally into international markets across many, many countries at one point, rather than slowly starting in one market and working their way across. They can launch brand new products, technological products. Think of OpenAI, ChatGPT, on an audience base that's willing to accept them in a fashion they wouldn't have done before. And because of the low capital employed nature, they can scale these products very, very quickly. So actually, growth companies now can grow far more quickly than they could do historically, with far less requirements for capital. And we believe that's what's driven the growth, the outperformance of growth or the underperformance of value over the last 15 to 20 years. What we've definitely seen in the last few years, as shown on the last chart, is that value and growth have compressed in terms of their valuation in recent periods. But we think now that's got to a place and a point where the valuation of growth is very attractive for a mid to long-term investor. I think it's worth setting the current market in context. we are going through the longest and deepest drawdown, mid-cap and small cap versus large cap, that we have seen for 40 plus years. This slide shows the previous cycles. There's the 87, 98, there's the tech cycle, global financial crisis, Brexit, COVID. And you can see that all of those, by now, mid-cap would have recovered the underperformance that it's seen versus large cap. Typically, it happens within sort of 300, 350 days, maybe a little more. But the point is, it happens quickly, and it would already have happened by now. This drawdown has continued. We are now 970 trading days into a very long and pronounced period of underperformance of mid-cap versus large cap. And the reason why we look at this, we think this is a good proxy of growth versus value. It's a good proxy of domestic versus international. There's all sorts of things that are encompassed by this. But what it does show is that there has been a flight to large cap companies and a flight away from mid-cap and small cap companies within the UK that's reflected this performance basis. And that flow picture is really very important. We think that this is at the heart of everything. This chart shows the flows in UK small and mid-cap funds going back to May 2000 or May 2020. And you can see that other than a very brief period of inflow in early 2021, there's been a pronounced and long-term trend of outflows in UK small and mid-cap. And actually, if we were to draw this chart back further and go back to Brexit 2016, you would see that since that point, there has been barely any inflow into the UK small and mid-cap market. This has been a perpetual and perennial drain on part of the market that we operate in, and it is driving investor behavior in a number of ways. Firstly, because investors are thinking about flows, they're thinking about near-term earnings rather than mid-term earnings. There is very little reason for an investor right now to think about the mid to long-term earnings power of a business that may disappoint in the next few months when there are flows coming out their portfolios. Human instinct will mean that they will sell the business that has near-term earnings uncertainty and keep hold of the business that has near-term earnings certainty. That means that we're not yet seeing any sort of recovered basis in terms of multiples being paid for stocks. Multiples have compressed over the near-term timescales. So there's this pressure on valuation that is being caused by these flows. The next impact on the IPO market. There's been very little IPO activity in the UK market in the last few years, and we'll talk about the de-equitisation of the UK market in a moment. But again, this principle of flows directing and dictating valuation also works its way through to the IPO market. A private equity firm that has a business held in its portfolio, to get that listed on the London market right now, it has to do it at a suitable discount to the underlying valuation you see in the UK. And that may well be significantly below where private equity has it marked at in its own books. So better to do a private-to-private transaction than to risk bringing onto the UK market. And the final thing in flows is it means that in many cases, share price momentum is not maintained. Shares that do well, that report strong earnings, tend to have a period where the shares outperform. And then as that valuation starts to move up, they become the next ones to be hit on the flow environment. And so it means that there is a compression of valuations. It means that there's a decline in the IPO market, and it means that performance is hard to maintain for individual shares. And as you can see the valuations here, this looks at FTSE 250 and FTSE small cap and compares it to the long-term average, and the chart goes back to 2005. You can see recently there has been a small bounce in the valuations, but it really is very small, the recovery that we're seeing. Ultimately, valuations of UK small cap and UK mid cap are roughly where they were in the global financial crisis or the European debt crisis. You know, these are significantly below peak valuations and significantly below the average valuations. Again, to reiterate, a large chunk of this coming from the flow that we're seeing in the UK market, or the continued outflow that we're seeing in the UK market. So the basis here is there's both the potential for a flow recovery, an earnings recovery, and indeed a multiple recovery for the underlying securities. And the universe itself is shrinking. This chart shows the number of IPOs in the UK market in recent years, IPOs above £100 million, and the number of constituents in the benchmark that we looked at, the Deutsche Numis small cap benchmark. Last year, there were 10 IPOs in the UK market above £100 million. That is the lowest level in the UK market since 1987. Again, to put that in context, there were more IPOs in the UK market in the depths of the financial crisis in 2008 and 2009 than there were in 2024. It comes back to the earlier question of flows. Why IPO if investors don't necessarily have the capital to put to new ideas? Why risk launching an IPO that simply doesn't have the demand? Or indeed, why launch an IPO when the valuations in the market are unattractive? Again, back to this point that IPOs must come or should come at a discount to the prevailing market valuations. Both of those conditions mean the IPO market remains relatively unattractive. And the second is the number of constituents continues to fall. M&A is still prevalent in the UK market. Companies are continuing to get taken out of valuations far above the valuations that they trade at in the market. Investors are accepting those bids with gratitude, again, given the flow environment. So the number of companies in the UK continues to fall. And that M&A environment has been a detriment to the portfolio's performance. For whatever reason, BlackRock smaller companies has not benefited in terms of M&A. The largest companies taken out of the benchmark last year, BlackRock smaller companies didn't hold any of them. And so actually, M&A has been a significant headwind to relative performance for the portfolio. And we have to be honest, there have been some stock-specific mistakes. This shows the detractors to performance last year. And we can see shares like YouGov, TT Electronics, where trading conditions deteriorated. What I think is important to understand here is that this is typical for a UK small and mid-cap portfolio to see disappointment at one end. What has been less typical is not to see the significant positives on the other side, again, through the fact that we don't seem to have taken part in the M&A, that the IPO market has been quiet, that the deal market has been quiet. There are also some here that we would describe as truly left field situations. The CMA investigation to CES Group being one of the obvious ones where we couldn't necessarily have seen that coming through the analysis. But there are reasons to be more positive. Firstly, we've spoken about the valuation growth versus value within the UK and how in the small mid-cap part of the market, those valuations have compressed. What's interesting to see is that typically, shown by the orange line here, UK small cap growth tends to trade at a premium to UK large cap growth. But given the flow conditions and the market conditions that we're seeing, that's not been the case for the last few years. But I think it's worthwhile highlighting some of the valuation anomalies that exist. When we look at the largest growth companies within the FTSE 100, companies like Rolls-Royce trading on 37 times, RELX trading on 30 times, London Stock Exchange trading on 28 times, investors are prepared to put a significant premium for growth in that part of the market. The same can't be said for the companies sitting within the small and mid-cap sector right now, where their valuations tend to trade around the mid-teens rather than the near 30s. Given that investors historically have been prepared to place a premium for growth on UK small and mid-cap, and demonstrably investors are prepared to pay a premium for growth in large cap, there is certainly room for multiples to expand once market conditions return to a more normalized basis. And the historic case for investing in smaller companies is clear. This chart goes back to the 1950s and shows the value of a metaphorical or physical £100 invested all the way back in 1955 and the compounding effect that has over time. If you'd invested your £100 in UK large cap, you'd have roughly £140,000 at this point in time. If you'd invested the same £100 in UK small and mid, well, that number is £835,000 over this period of time. The compounding nature of small and mid cap investing really has historically built up over time. Whilst those numbers and the differential between those is large, that actually represents slightly less than 4% compound excess return every year. Such is the power of compounding return in investment. And most of that 4% outperformance has come from the fact that, typically speaking, UK small and mid-cap companies grow their earnings at a slightly higher rate than UK large-cap companies, typically around 3.5% a year. And so whilst we can't sit here and say this is bound to happen in the future, history tells you that the compounding nature of UK small and mid-cap does tend to lead to outperformance over a long term and for those with a longer term investment horizon. What we have seen over the last few years, given the level of underperformance of UK small and mid, is that we're now in a 10-year period where that outperformance hasn't happened. And so the question going forward for any investor is, do we think something has fundamentally changed about the growth outlook and the growth capability and the valuation of UK small and mid cap companies versus UK large cap companies? This is the current top 10 across the portfolio. And I'll highlight this just to show a couple of things. Firstly, in terms of our portfolio characteristics and how we build the portfolio, you can see the largest holding, XPS Pension Groups, is at 2.9% of the portfolio. We have typically limited holdings 3% of the portfolio within the small and mid cap names. That way we don't overexpose ourselves to one particular position. The second thing is you can see a wide range of sectors there and a wide range of exposures, speaking to the bottom up building of the portfolio. So what do we think going forward? Where do we think the interest should come in the market in the next 6 to 12 months? Well, last year we have said that we were positive on the consumer. We would have said that real wage growth was starting to increase, that employment was under control, the savings ratio was increasing, the consumers actually had cash in their bank accounts, which, should they get more confident, they have the propensity to spend. At the same time, inflation was falling, swap rates were falling, mortgage rates were starting to improve. We still believe that those conditions are in place. The savings ratio is still at historically high levels. Real wage growth is continuing to come through. Yes, unemployment is increasing slightly, but still well within historic norms. And so we think as consumers get more confident, we'll start to see spending some of that money. And we have seen it recently in the results of some of the retailers and the results in the like-for-likes and some of the pub and restaurant stocks. So clearly the consumer has a little bit more money to spend. Interest rates are falling, and that will have an impact on mortgage rates. And there is a wall of mortgage refinancing coming over the next couple of years that consumers have probably been preparing themselves for. But as those rates start to fall, and as those mortgages are locked in, again, the consumer can look to the future with a bit more confidence and a bit more certainty. Property stocks continue to trade at a significant discount. You can still buy many property stocks on a 30 or 40% discount to their NAV. And we've seen it in the M&A this year. The property has been one of the sectors where that activity has been carried through as outside investors look to secure some of the valuation that we see, some of the attractive valuations that we see there. We believe that construction is still a good place to be, both from a recovering housing market, a recovering RMI market, but fundamentally the infrastructure that needs to be put in place within the UK. Aerospace and defence, I think, goes without saying. The uncertainty that we're seeing in the geopolitical environment right now leads to an overweight for those sectors. So I'll leave it here and pass over to Q&A.
Perfect, Roland. That's great. And thank you very much indeed for your presentation this afternoon. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the right-hand corner of your screen. But just while the team take a few moments to review those questions that have been submitted already, I'd just like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can all be accessed via your investor dashboard. Roland, as you can see there, we have received a number of questions, so perhaps if we dive straight into it. The first question that we have here reads as follows: what do you think brings IPOs back to the UK market?
Yeah, I mean, I think that's a very important question for the state of the market going forward. As I've said, I think the biggest single issue for much of what's going on in the UK right now, whether that be valuation, whether that be performance, whether that be the ability of investors to look through near-term earnings, has been that flow environment. And so you have to ask the question, to bring back the M&A market, what brings back the flow environment? And I think that is the catalyst to so many things. So the first question to ask is, what has caused the negative flow? Where has that money been going? And obviously we've seen withdrawals, we've seen clients redeeming from open-ended UK small and mid-cap portfolios, and that has been a fair chunk of the outflow that we've seen. But also what we've seen over the last few years is all cap investors in the UK move further up the market cap. Going back to that point I made earlier about the performance of large cap growth versus small and mid cap growth, a lot of that is dictated by flow. And so those fund managers need to get convinced that the UK recovery is something that is in motion, and to move further down the market cap spectrum, increasing the risk in their own portfolios. The second is international. International investors, there is no doubt, have moved away from the UK in recent years. And clearly a large part of that, not making any political judgments here, the large part of that is the uncertainty that was seen at the tail end of the Conservative governments of the UK. The amount of changes of Conservative prime ministers, the amount of changes of Conservative ministers, what was our policy to Europe or the US or all these other things. That uncertainty made it very difficult for international investors to take part in the UK, regardless of the valuation. And I think under the Labour Party, whilst there's still some geopolitical uncertainty, clearly, I think the Labour Party has steadied an awful lot of that debate recently with the overwhelming majority that they have got. So the UK starts with more attractive from an international investor point of view as well. So international investors start to come back. UK managers start to invest further down the market cap spectrum. Retail investors start to get a bit more risk appetite, again linked to the certainty that we start to see. And all of those things start to bring flows back into UK small mid, which themselves start to improve the valuations and starts to improve the capability of capital for the IPO market. So for me, all things come back to flow.
Perfect. Thanks, Roland. Just turning to the next question that we've got here. How do you think about the difference between AIM and the main market?
Yeah, I mean, that again is a very apt question for the environment that we're in right now. Historically speaking, we have looked at AIM in exactly the same way we look at any market. There is a history that comes with AIM, there is a reputation that comes with AIM, and there has historically definitely been some bad actors on the AIM market. But ultimately, the companies that behave appropriately on AIM, the more mature, higher market cap, greater liquidity, typically companies, tend to adhere to all of the codes that they need to. They give you fully audited information. They stick to the quoted companies codes. They have AGM voting that they stick to, even though they don't need to under the AIM rules. And so we've always felt that actually there is a very appropriate universe within AIM, a subset of AIM, that we can take part in and can be involved in. And so the portfolio historically has been 40-45% invested in AIM. The same isn't true today. We are down to, I think, roughly 20% in AIM today. And that's a reflection of a couple of things. Firstly, it's a reflection of the fact that the AIM market itself has been under some pressure recently because of some of the changes in the IHT rules and what that's caused to happen to some of the flow perspective. But secondly, I think importantly, what we've seen is a number of companies make the AIM to main move. And so actually some of the companies that we did have listed in the portfolio are now listed on the FTSE 250. Same companies, we haven't had to sell them, but the designation is clearly different. And I think that's going to continue. I think there are some pressures on AIM from both a reputational side, but also a flow perspective, which companies can avoid by going full list. So those at the larger end of AIM who can transfer across to the FTSE 250, I think we'll continue to see that happening.
Thanks, Roland. Given your recent performance, is the investment process still relevant?
Yeah, I think that's a very appropriate question. I mean, firstly, we're not shying away from the performance. We know that it has been challenged in recent years. And some of that clearly has been stock selection. There have just been some things that we got wrong, some ideas which we held on to for too long. Some where we did actually analyze the fact that Yugo, as an example we used before, where we did actually analyze that there'd be a problem that liquidity meant that it's difficult to move out of the positions. I think when we look at the investment process and we look at how much growth has underperformed value over the last 3 or 4 years, and where the valuations of growth versus value in UK small mid cap sit, I think there's a hugely exciting opportunity in UK small and mid cap growth sitting in front of us. I think you can look at the UK small and mid cap market, and there are many companies that have been listed for a very long period of time. And lots of those sit within sort of a value dynamic. Ultimately, it's a sort of a paradox of UK small and mid cap investing. We don't want companies to be listed on the small cap market for 20, 30, 40 years. We want them to accelerate through small cap into mid cap and into large cap, because that's where you're getting the rewards. And we think that the subset of quality growth companies sitting within the UK is appropriately valued. Is attractively valued. When we look at the investment process and the way that we analyze companies, the fact that we do 700 or 800 company meetings a year, that gives us a treasure trove of information. That is a very valuable part of the research process. That one-to-one contact with companies is really, really important. And so that part of the process we still think is totally appropriate and definitely wouldn't want to change. And so then it's sitting and looking through the 5 factors, the lenses that we use to analyze the companies we look at. And the strength of the balance sheet, the cash flow generation, the quality of the management team, the long-term track record of the business, the market position of the business, these aren't necessarily revolutionary. I think, as said many times, the flip side to those is saying you want to invest in a terribly run business on the verge of bankruptcy with an awful market position, and clearly that isn't the case. So the fact that we look through those 5 lenses, whilst it looks quite simplistic, actually it's amazing how quickly things can go wrong in UK small mid cap if you start to deviate from those 5 core tenets of the investment proposition. So we still think the way we look at companies is appropriate. We still think that the meeting companies, the first-hand contact, is really, really vital. And we think that the valuation growth is really attractive right now, particularly in the context of the valuation of value in other parts of the market. So we still fundamentally absolutely believe that the investment process is appropriate.
Thank you. And perhaps one final question here, which asks, what is the trust's current level of gearing?
Yeah, so today we are sitting at about 6% gearing. And typically we have a range of about 12 to 15. I think at the current juncture, given the amount of geopolitical uncertainty and the lack of total clarity on so many parts of the market right now, in terms of what are the drivers at risk, I think it's appropriate to have a lower level of gearing at this moment in time, with the ability to divert that capital as we see more clarity. I think the market dynamics seem to change on an almost daily view right now. Until we have a bit more clarity, I think it's the wrong thing to do to really step into the gearing.
Thanks, Roland. And that actually concludes the questions for today. So thank you very much indeed for being so generous with your time and addressing all of those questions that came in. And of course, if there are any further questions that do come through, we'll make these available to you immediately after the presentation has ended. But Roland, perhaps before really now just looking to redirect those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments just to wrap up with, that'd be great.
Yeah, I hope what I've laid out here is that the UK small and mid-cap market, and particularly the UK small and mid-cap growth market, has been through some very challenging times. But ultimately, we don't believe that anything is fundamentally broken here. We think that this is a particular moment in time post a significant amount of disruption caused by inflation and interest rates and various other things that have gone on, particularly within the context of the UK. Which has now presented a valuation opportunity in the part of the market that we think is fundamentally attractive for the mid to long term. And we do, over time, believe that would be the appropriate place to invest, and that valuation opportunity will present itself and offer significant potential rewards over the coming time.
Perfect, Roland. That's great. And thank you once again for updating investors this afternoon. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of the BlackRock Smaller Companies Trust PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.